welcome to Saxo Bank's Market Call, brought to you live from Copenhagen, Denmark. Today is Tuesday, 5th of February. Let's start our presentation with the overnight news items. It was actually a rather quiet session yesterday with relatively few key market-moving economic releases in the market. Just to mention a few important ones, we had Eurozone PPI for the month of December coming out exactly as expected at 0.1% monthly and 4.3% yearly, sort of easing slightly the inflation concerns in the Eurozone area. In the afternoon from the U.S. session, we had U.S. challenger job cuts for the month of January as well as the factory orders for the month of December, both disappointing in terms of expectations and as absolute values. The factory orders showed an expansion of 2.3%, while the markets had expected expansion in the amount of 2.5%, and the challenger job cuts for the month of January were at 19.1%, and this contrasted very starkly against the prior figure of minus 18.7%. Perhaps the most important figure in the Asian session was the Australian Reserve Bank of Australia's decision to hike its key interest rates by 25 basis points, taking the key interest rates in Australia to 7% from 6.75% prior. This is also interesting as Australia is the only country where the interest rates have actually been hiked, the only developed nation where the interest rates have been basically rising after Fed's consistent easing policy. In the market, the yen is now nearing 3-week low against the Aussie dollar, and this is primarily on the effect of the Australian rate hike. The other carry trade pairs are also very well supported and very well bought in, and this is basically a continuation from the early week. Dollar is sort of assumed a defensive posture, with euro dollar now trading near 148. On the equity markets, we had somewhat of a mixed session in Europe. This was, however, followed by broad losses in the US. Nasdaq closed the day down by 1.26% and S&P about 1%. The slide in the equities sort of spilled into the Asian session, dragging Nikkei down by about 0.8% and 80%, and Hang Seng retreating by about 0.5%. On the fixed income markets, treasuries and bonds are little change. Treasuries had a really nice bullish run yesterday on, again, the continued rate cut speculation in the US. At the same time, in Japan, the JGPs are actually falling, and this despite the falling equity. So we've seen both Japanese equities as well as the government bonds falling overnight, and the reason that the Japanese government bonds are falling at this point is primarily stemming from the speculation that the Bank of Japan would actually avoid any further rate cuts this year, despite the slumping economy. In the commodity markets, crude is lower, and it is lower on the estimations that the energy inventories later this week would show larger than expected build-up, with the March contract now trading around $89.67 a barrel. On the precious markets, the precious metal side, the gold as well as silver are little changed. The gold spot price is just about $900 an ounce. Silver range bound likewise, with the current spot price now at $16.67. So what's going on in the marketplace? Well, overnight, the U.S. equities were broadly lower, and they were broadly lower because they were dragged down by news on both American Express being cut from by a group of UBS analysts, basically taking their recommendations from neutral to sell, as well as Wells Fargo and Wachovia, which are 4th and 5th largest U.S. banks respectively, suffering the same analyst cuts, this time around by Merrill Lynch. So again, a continuation in a long line of troubles in the U.S. credit sector, now spilling more and more firmly into credit card business. The 4-day rally in Asian shares have now been cut, as we mentioned before, and this was on a double effect. both from the falling U.S. equities or the concerns that the financial crisis or the credit crunch is more firmly taking root in Asia, as well as some disappointing earnings or the earning warnings. Yamaha Motor and Olympus Corp were the two Japanese companies that came out with earning warnings and sort of dragging the rest of the equities down with them. Finally, a point on the Australian rate hike. As we mentioned, Australia is one of the or the only Western bank that has actually hiked its interest rates post FOMC action in the US. The interest rate is now at 7%, and this represents an 11-year high. And with the inflation, the annual inflation still overshooting the Australian Reserve Bank's target, and the underlying economy still showing fairly robust growth, there is reason to think that this may not be the last time that the Australian bank raises or hikes its key interest rates this year. The calendar today is fairly light. Again, the official or the important items rather are the Eurozone retail sales. This is at 10 o'clock GMT. Later in the day we have the ISM non-manufacturing business, the index value for the service sector. Basically, this is at 15 o'clock GMT. Much later in the US session at 10 p.m. GMT, we have the ABC consumer confidence, and this is a figure from the 3rd of February. Coming highlights already show more active economic calendar. On 6th of February, that is tomorrow, we will have U.S. crude oil inventories, gasoline inventories, as well as the distillate inventory. So the key energy figures will be released tomorrow from the U.S. We have the Kiwi unemployment, as well as the employment change in the Asian session, followed by Canadian building permits. On 7th of February, this is Thursday, we have the rate decisions from both UK. Bank of England will be announcing its rate decision, and at the same time we will have the ECB also delivering its key interest rate. We also have Swiss CPI on 8th of February, as well as German trade balance and current account figures. So they will give us more direction on euro for the foreseeable future. Finally, Canadian unemployment rate will be released on 8th of February. Our recommended FX strategy of today is in euro-pound. We believe that the rate cut, or the expected rate cut of 25 basis points from Bank of England, has been fairly, by and large, factored into the sterling value. At the same time, we feel that euro can come under increasing pressure ahead of the G7 meeting later this week. So we are shorting the pair at the market and putting a stop at 0.7527 bit and targeting a move down to 0.7450. Our recommended equity strategy for the day is in the Danish bank, Danske Bank. The Danske Bank released its earnings last week, and this was actually better than the analyst expectations. This sent the stock surging. However, Danske Bank equity prices have since failed to follow through, and our technical indicators are giving us indication that the stock is at an overbought level. Hence, we are selling Danske Bank at an entry range of 182 to 184, initially targeting 173. We are keeping a stop loss above 190 corona. Finally, the recommended future trade of the day is in crude oil. We are selling the March contract at $90 to $90.40 area. Again, that was $90 to $90.40. We are targeting the $88.70 area, and we are putting a tight stop loss order at $90.60. We had a fairly low volume session yesterday, and the news that the dense fog could create delivery problems in Houston ship channel has put added pressure on oil prices. That is it for me today. Thank you very much for joining us. See you again tomorrow. Bye-bye.